Good day, everyone. We are Group 1 and we are pleased to present our report on the topic of partnership dissolution, change in ownership structure. In today's presentation, we will walk you through the key aspects of partnership dissolution, including the distinguished dissolution with changes in ownership structure from dissolution with liquidation. Number two, we have distinguish between admission of partners by purchase of interest from admission of partners by investment. Number three, to learn the topic regarding bonus. Number four, learn what adjustments are to be made when a partner withdraws or retires from a partnership. And the last one, we have conversation of a partnership into a corporation. So, in introduction of this topic, a partnership contract is built on mutual trust, where partners have the freedom to choose their associates. When a new partner joins the business, it requires the agreement of all existing partners, which typically leads to the dissolution of the original partnership and the formation of a new partnership agreement. Importantly, this transition does not disrupt the ongoing business operation. So, for example, if partners A and B decide to bring in partner C, their existing partnership agreement is dissolved and a new agreement is created. This new contract will outline important changes such as adjustments to profit sharing ratios and capital contributions based on the introduction of the new partner. So the next one is the partnership dissolution. So according to the article 1828, dissolution of a partnership is described as the change in the relation of the partners caused by any partner ceasing to be associated in the carrying out of the business. In simpler terms, partnership dissolution occurs when a partner decides to leave the partnership, or in some cases when a partner is removed from the business. So this change in the relationship of the partners effectively ends the old partnership, whether it is due to the departure of one or more partners. So the termination of the partnership's businesses or any other reason that alters the original partnership structure. So we have the two kinds of partnership dissolution. No? Number one is the dissolution by change in ownership structure, which covers the following. So, sa number one, we have the admission of a new partner in the existing partnership. And letter B, the retirement or withdrawal of a partner. So, yung retirement no, and on withdrawal sa imuhang partner. So, letter C, we have the death, bankruptcy, or incapacity of a partner. And the last one, we have the incorporation of a partnership. So sa dissolution with liquidation of the other hand, the partnership business will stop to operate. So it is the end of its life, so that the business will focus on the following terminal activities such as sale or conversion or of non-current assets into cash. So B, we have also the paying its liabilities, and letter C, distribution of cash and the remaining unsold assets to individual partners. So in the admission of a new partner in existing partnership, so there are two types of admitting a new partner in existing partnership. These are by purchase of interest and by investment. So by purchase of interest, no, by purchase of interest, a new partner can be admitted in an existing partnership by allowing him to purchase the whole interest or portion thereof from one or more of the existing partners. So the term interest refers to a partner's equity um, or capital in the partnership which compromised his original investment. So his share of the partnership profit or loss and his withdrawals. So the new or incoming partner is referred to as buying partner, and the old or existing partners was the selling partners. So another term of this is a new partner can be admitted into an existing partnership by purchase of interest. So which means the new partner buys part of or all of the equity from one or more existing partners. So the interest refers to a partner's capital or in a business. So including the original investment, share of profits or losses, and any withdrawal made. So um, the new partner is called the buying partner, no? So let's go back to the previous slide. So the new partner is called the buying partner. And then the existing partners who sell their share are called the selling partners. So this process does not require the new partner to bring in new capital, but instead acquires ownership by purchasing a stake from the existing partners. Sorry. This transaction alters the ownership structure and may require adjustment to the profit sharing ratios and capital contributions, which are typically reflected in a revised partnership agreement. So now let's proceed to the formal journal entry, transfer or interest. So debit capital account of the selling partner. So it is common, no? Debit. We have also the credit capital account of the buying partner. So the meaning of debit, it is this entry reduces the selling partner's capital account. So as they are transferring part or all of their equity to the buying partner. So the selling partner share of the business decrease as a result of the sale. So while the credit means capital account of the buying partner known as this entry increases the capital account of the buying partner reflecting their purchase of the ownership interests. The buying partner now holds a stake in a business and their capital accounts grows grows something ano na siya. And then the above or proformal journal entry has the effect of decreasing the capital buying or balance of the selling partners. Entry will set up the capital account of the buying of new partner which establish his co-ownership in the business already. So So to illustrate, no, for the case number one, purchase of a portion of interest from one partner only. So let us assume that Peter and Paul are partners with capital balance of 60,000 pesos and 80,000 respectively. So they share profit and losses equally. So Mary is admitted in the partnership by allowing her to purchase one third of Peter's interest. So for the assumption, so number one Mary pays 20,000 at book value. Number two, Mary pays 15,000 less than its book value. And number three, Mary pays 25,000 more than a book value. So the book value of Peter's interest purchase by Mary is 20,000, which is one third of 60,000 pesos. So in a match as the partner's only concern is to record the transfer of interest from the selling partner to the buying partner at book value. So regardless of the amount to paid, the entry to record Mary's admission under assumptions 1, 2, and 3 is journalized as follows. So the Peter's capital from debit with the total amount of 20,000 pesos. The Mary capital is uh, to the credit is 20,000 pesos. So meaning is to transfer one third Peter interest to Mary.
So case 1, capital balance before admission. Peter Capital has a 60,000 credit, while Paul Capital has a 80,000 credit. During admission, Peter Capital has a 20,000 debit, while Mary Capital has a 20,000 credit. In capital balance after admission, Peter Capital has a 20,000 credit, 60,000 for debit, and 40,000 for debit. Paul Capital has a 80,000 credit, while Mary Capital has a 20,000 credit. Before admission, Peter has a 60,000 while Paul 80,000, total of 140,000. After admission, Peter has a 40,000 while Paul 80,000 and Mary 20,000, total of 140,000. Journal entry debit Peter capital as 60,000 to remove Peter's capital interest from the partnership. To record Mary's to record Mary's investment as she purchases Peter's entire interest in the partnership, Mary capital has a 60,000 credit. This reflects the transfer of Peter's capital interest to Mary, and the partnership's total capital balance remains at 140,000, now distributed as follows. Paul Capital has 80,000, no change. Mary Capital 60,000. Mary has purchased Peter's interest. In capital balance says after admission, Paul has 80,000 and Mary has a 60,000. Total capital 140,000. In case 3, purchase of portion of interest from more than one partner, let us assume that Peter and Paul are partners with capital balances of 60,000 and 80,000 respectively. They shared profits and losses equally. Mary is admitted in the partnership by allowing her to purchase one half of Peter and one fourth of Paul's interest. In journal entry, Peter Capital has a 30,000 debit, while Paul Capital has a 20,000 debit. Mary Capital has a 50,000 credit to transfer one half of Peter and one fourth of Paul interest to Mary. So Peter one half of 60,000 equals to 30,000. Paul one fourth of 80,000 is 20,000. Total interest transferred is 50,000. Case 4. Purchase of whole interest from all partners. When all partners allow the whole of their interest in the partnership to be purchased by one person, the transaction tantamounts to selling of the partnership business. In this case, the partnership business converted into a sole proprietorship. The entry to effect the transfer is Peter Capital has a 60,000 credit, Paul Capital has a 80,000 credit, while Mary Capital has a 140,000 debit.
Goodwill is an intangible advantage that increases earnings over what is normal under Philippine Financial Reporting Standards, which is PFRS. And number three, goodwill represents the excess cost of the business combinations over the fair value of the identifiable assets obtained. Therefore, the standard provides that goodwill attached to the business as a whole and is recognized only when a business is acquired. These provisions of PFRS number 3 outlaw the use of goodwill method in the partnership, particularly admissions of partner and retirement of partner because there is no business involved. When the purchase of interest is more than the book value, the excess amount cannot be treated as goodwill. Next, extended illustration partnership book is adjusted before admission. The manner a partnership book will be adjusted is similar with that of adjusting a sole proprietorship book prior to the partnership operation. The capital adjustment account is a later close to the partner's capital account based on their respective profit and loss ratio. In this the Palos Verdes commercial statement of financial position as of 30 June 28. In this tape, the adjusting journal entries AGES are posted to the general ledger account. The amount are provided into two columns, typically for debits and credits. The adjusting entries are their effects on the general ledger accounts might look like this. Capital adjustment, there are debit capital adjustment, credit capital adjustment. The capital adjustment have 7,000 and the credit capital have 15,000, and there are 10,000. Next is the 15,000 and 1,000 pesos. And the total debates and credits, the total debates has 18,000. Some of the debates is 7,000 plus 10,000 plus 1,000. The total credits is 30,000. Sum of credits is 15,000 plus 15,000 voting the accounts. After posting the entries, the footing refers to the process of calculating the total balance in each account. You vote each ledger account by summing the debates and credits, calculating the net balance. For example, if the debits and credits in the capital adjustment accounts are posted, you would put the account to determine if the account is balanced or if there's a net change. Debits is 18 pesos, 18,000 pesos, and the credits is 30,000 pesos. The balance in capital adjustment accounts, once the totals are voted, capital adjustment account would have a net credit balance of 12,000 pesos and 30,000 credits minus 18,000 debits. Uh, mer- uh, the The provision of the doubtful account should be increased to 12,000 pesos. Merchandise should be revalued at 115,000. Deliver equipment is under depreciated by 10,000 pesos. Store furniture has a fair market value of 35,000 pesos. And lastly is accrued interest on notes payable in the amount of 1,000 pesos is not yet recorded as of the date of statement of financial position is prepared. Step 1. The adjusting journal entries that are required in the book of the partnership are as follows. The first is capital adjustment as 7,000 and also allowance for doubtful account also 7,000. The merchandise inventory is 15,000 and also capital adjustment is 15,000. Capital adjustment and account depreciation delivery equipment are the same 10,000 pesos, and account depreciation store furniture and capital adjustment is same 15,000 pesos, and capital adjustment and accrued interest expense is 1,000 pesos. And step 2, post the entries to the general ledger and vote, and for illustration purposes, only the accounts affected in the adjusting journal entries has shown. Capital adjustment, there are 7,000 plus 10. Next is the 15,000, and next is 10,000, and the fourth is 15,000, and last is the 5,000. The total of 7,000 plus 10,000 and plus 1,000 is equals 18,000, and the 15,000 plus 15,000 is equals 30,000. Merchandise beginning balance is 1,000 pesos. There is a debt of 15,000 pesos. The ending balance is 115,000 pesos, and the allowance for doubtful accounts there are 5,000 pesos, and 7,000 pesos equals to 12,000 pesos, and the account depreciation delivery equipment there are 70,000 pesos plus 10,000 pesos equals 80,000 pesos. Account depreciation and store furniture. In account depreciation, there are 15,000, and the store furniture there are 40,000 pesos and 25,000 pesos, and the accrued interest expenses there are 1,000 pesos.
Merchandise. Debit 15,000, allowance for doubtful accounts, credit 12,000. Account depreciation, delivery equipment 80,000. Account depreciation, store furniture 25,000. Accrued interest expenses, credit 1,000. Step 3. Close the capital adjustment account to the old partnership capital accounts according to their profit and loss ratio. Since the said account is with credit balance of 12,000 after the adjustment to close is to debit the said account as follows. Capital adjustment 12,000. In Salva Capital 6,000. In Modelo Capital 6,000. The closed capital adjustment account by distributing the balance equally. Effect: the capital account balances of the all partners increase are as a result of the adjustment as shown in the T accounts. M Salva Capitals 92,000, share 6,000, total is 98,000. In Modelo Capital 118,000, shares 6,000, the total is 24,000. The capital of M Salva after the adjustment is 98 while the capital of N Modelo is 124,000. Step 4. Transfer one half of M. Salva and N. Madelo's respective entries to P. Dalucanog. The entry is M. Salva capital 49,000, N. Madelo's capital 62,000. P. Dalucanog capital 111,000. To transfer one half of M. Salva and in Modelos entries to the Lucano computed as follows. M Salva 98,000 times 50% equals 49,000. In Modelos 124,000 times 50% equals 62,000. The total is 111,000. M Salva Capitals 92,000 share 6,000 98,000. Transferred 49,000. Debit 98,000. Debit 49,000 balance. New partnership P. Dalocano Capital 49,000. 62,000. The total is 111,000. And Modelo Capital 18,000, shares 6,000, transferred 62,000, 124, balance is 62,000. The capital balance of the partnership before and after the admission as abstract from their respective T accounts are follows. Before admission, M. Salva 98,000 and Modelo 124. The total is 222,000. After admission, M. Salva 49,000 and Madelo 62,000. P. Dalucanog 111,000. The total is 222,000.
Admission by investment. Admission by investment occurs when a new partner joins a partnership by contributing assets. This contribution increases both the partnership's total assets and its capitalization, which is crucial for the growth of the business. Now, let's talk about the bonus method. This method involves the transfer of capital from existing partners to the new partner, recognizing their reputation or earning capacity. It's important to note that bonus is not an account title, rather, it reflects a change in capital balances among partners. To understand this transaction better, let's define a key terminologies. First is total agreed capital. It refers to the new capital amount set by all partners. Second is total contributed capital. It refers to the combined capital from both old and new partners. Third is total credit of new partner. It refers to the equity interest of the new partner. And the last one is total contribution of a new partner. It refers to the actual amount contributed upon admission. Let's look at an example. Suppose Lada is admitted into a partnership with Alea by investing 50,000 pesos for a half interest in a total agreed capitalization of 150,000 pesos. Lada's capital credit would be 75,000 pesos, half of the 150,000 pesos. Since she only contributed 50,000 pesos, she receives a bonus of 25,000 pesos from Alera and Padayo. The journal entries would be as follows. Cash is 50,000 pesos and E-Lada capital is 50,000 pesos. Now, let's record the bonus given to Lada. G. Alera capital is which is 70% of the 25,000 is 17,500 pesos, and M. Padayaw capital which is 30% of 25,000 is 7,500 pesos. Ilada capital is 25,000 pesos. This results in reduced capital for Alera and Padayaw. The capital of Alera and Padayaw, as they provide bonus on 70% to 30% basis, were being reduced to 42,500, 60,000 to I minus 17,500 and 32,500 pesos, 40,000 minus 7,500 respectively. Bonus to old partner. Using the same illustration, let us assume that Lada is to be admitted in the partnership of Alera and Padayaw by investing 50,000 for a one-fourth interest in the new firm. Capital is 50,000 pesos. Ilada capital 50,000 pesos. Then we record the bonus given to Alera and Padayaw based on their ownership percentages. The journal entries for this scenario would be Ilada Capit Ilado Ilado Ilada capital is 12,500 pesos. G Alera capital which is 70% of 12,500 is 8,750, while M Padayaw capital which is 30% of 12,500 is 3,750. This reflects the distribution of bonuses among existing partners.
Neither the new partner nor the old partner receives bonus. Using the same illustration, in this example, Lada is joining a partner by contributing 50,000 in cash. This amount is for a one-third ownership interest in the total partnership capital, which now adds up to 150,000. Since Lada's investment 50,000 is exactly one-third of the new total capital 150,000. She doesn't receive a bonus and neither do the existing partners Peter and Paul. The journal entry records Lada's contributions as follows: debit cash for 50,000 to show the money Lada invested. Credit Lada capital for 50,000 to reflect her ownership in the partnership. After this, the total capital in the partnership is updated to 150,000 divided among the partners as Peter 60,000, which is 40% of the total. Paul is 40,000, which is 27% of the total. Lada is 50,000, which is 33% of the total. Each partner share is now in proportion of their capital. So everyone's ownership is correctly represented without any bonus adjustment. Withdrawal or retirement debt, bankruptcy or incapacity of the partners. Withdrawal, withdrawal or retirement of a partner. When a partner decides to withdraw or retire from the partnership, they stop being part of the business. This can sometimes lead to the closure or liquidations of the business, but in many cases, the partnership can continue operating without any interruption. The remaining partners may adjust the business structure or reassign the responsibilities to keep things running smoothly, depending on the agreement they have. Essentially, even if partner leaves, the business doesn't always have to end if the remaining partners choose to continue. There are three the basic counting problems involved are as follows. First is the sale of interest to an outsider. In this example, Lada, an outsider, wants to join the partnership by purchasing 40,000 worth of interest from Paul. Before the sale, Peter has 60,000 capital and Paul has 80,000 capital, giving a total partnership capital of 140,000. After the sale, Paul's capital decreases by 40,000 because he sold that portions to Lada. The Lada invests 40,000 to join the partnership. So now Peter still has 60,000 Paul's capital to reduce to 40,000 and Lada has 40,000 as her share. The journal entry for the sale is as follows. Debit Paul capital 40,000. This shows that Paul's capital is reduced by the amount he sold to Lada. Credit Lada capital is 40,000. This shows Lada new investment as she becomes a partner. Credit cash is 40,000. This records the cash Lada paid to Paul for her share. After this transaction, the total capital of the partnership remains the same at 140,000. The ownership distribution changes. Peter is 60,000. 60,000 is 43% of the total capital. Paul is 40,000, 29% of the total capital. Lada is 40,000 is 29 of the total capital. This means that Lada now owns a 29% share in the partnership, while Peter and Paul's share are adjusted accordingly.
The second is sale of interest to one or more of the remaining partners. So in this case, Peter and Paul are partners with initial capital contribution of 60,000 and 80,000 respectively. The total partnership capital is 140,000. Peter sells 20,000 of his capital interest to Paul. This is an internal transfer. No outside capital is involved. Peter capital decreased by 20,000 to 40,000. Paul's capital increased by 20,000 to 100,000. So total partnership capital remains unchanged at 140. This is the overall value of the partnership hasn't changed. Only the ownership contribution. So the journal entry is a debit to Peter capital 20,000. This entry reduces Peter's capital account reflecting his sale of capital. Credit to Paul capital 20,000. This entry increases Paul's capital account reflecting his purchase. Debit cash 20,000 is entry records the cash payment Paul made to Peter. So ownership Ownership contribution after sale. Peter now owns 28.57% of partnership. Paul now owns 71.43% of partnership. The scenario demonstrates a straightforward internal transfer of ownership within a partnership, resulting in a redistribution of ownership percentages, but no change in the capital partnership. So third is sales of interest to the partnership. The scenario describes a partnership between Peter and Paul, with Peter having a capital of 60 and Paul
having 80,000. Peter decides to sell 20,000 of his capital interest back to the partnership. This transaction affects the capital balances of the partners and the partnership itself. Before the sale, the total capital of partnership was 140,000. So Peter sells 20,000 of his capital to the partnership. This means the partnership now holds a portion of its own capital. Peter's capital is reduced to 40,000. Paul's capital remains unchanged at 80,000. The partnership's capital increased by 20,000, reflecting the purchase of Peter's shares. The total capital of the partnership remains 140,000, but its composition has changed. So in our journal entry, debit to Peter's capital 20,000. This reduces Peter's capital account to reflect the sale. Credit cash 20,000. This shows the cash received by Peter from the partnership. Debit to partnership's capital 20,000. This increased the partnership's capital account to reflect the purchased Peter's share. This transaction illustrates how a partnership can repurchase a partner's interest. This is a common occurrence, particularly when a partner wants to reduce their involvement or withdraw from the partnership. The repurchase does not change the overall capital of the partnership, but it does alter the proportion of capital held by each partner and the partnership itself. It's important to note that this transaction requires a formal agreement among the partners.
Next is that Next is debt bankruptcy or incapacity of a partner. When a partner die and become bankrupt, the partnership ends. This can lead to the two outcomes. First is liquidation. The partnership assets are sold, debts are paid, and remaining profits are distributed among the partners. And reformation, the remaining partners may choose to continue the business by creating a new partnership agreement. There are two things to establish at the time of these events. These are revaluation of asset. The partnership asset are reassigned and any necessary adjustment and made to reflect their current value and determination of profit or loss. The profit or loss from the last financial closing date up to the event must be calculated.
So now we are going to illustrate the example of the partners, no? So we have the Bakada, our partners who shared profits and losses equally. So si Dada Kuno is namatay on June 1, 2008. Sorry for the word. In this scenario, the partnership must adjust its accounts following the death of partner Da on June 1, 20B to determine his profit or loss and establish his capital interest. Thus, capital balance was 45,000 pesos as of December 21, 20A. From January 1 to June 1, 20B, the big income and expense summary account show a credit balance of 15,000 pesos, reflecting the profit during this period. So these adjustments are the crucial for accurately settling this account and ensuring fairness among the remaining partners. So the journal entry to distribute profit, no, so si June 1 20B, the account is from account income and expense is from debit, which is 15,000 pesos, and to the summary of the capital is 5,000 credit, ba capital is 5,000, and ka capital is 5,000 pesos. So the capital account balance of the shown below is 50,000 pesos after his share of profit. So the capital from the credit side, which is the 45,000 pesos, and minus plus the 5,000 pesos of June 1, 28 as of his debt is equal to 50,000 pesos. So if that interest is given to his heirs, the journal entry is debit from the capital of the is 50,000 pesos and credit of cash of 50,000 pesos. So in final, the DA capital is 50,000 pesos and ka capital is 50,000 pesos. So let us proceed to our last topic, which is the incorporation of a partnership. No, so when a partnership converts into a corporation, the partnership contract is dissolved. So as what I learned about from my past topics of the a partnership requires two or three members of a business. So if more than that, it will be involved to corporation. So that's why the reason the contract is dissolved when there are many members to join the partnership. So the partnership assets are adjusted to their fair market values and all liabilities must be recognized. So these adjusted assets and liabilities are then transferred to the new corporation. So in return, the corporation issues shares equivalent to the net assets being transferred. So net assets is are defined as the total asset uh, of the partnership minus its liabilities. So that's all, guys. So I just want you to give the motivation of accounting. No, so accounting is the language of business. Master it, and you hold the key to understanding growth and success. So thank you so much for listening, guys. I hope nakalearn mo sa mga topic nga among gihatag sa inyo.